So what we're going to talk about today is cash value, whole life, and the funding. It's all about the funding. As a matter of fact, that'll probably be the title. It's all about the funding because at the end of the day, you're looking for growth on your money and you're looking to accumulate money. And whenever it comes to infinite banking and these properly structured whole life policies, and there's different structures for different people's needs, in my opinion. Some people talk about different percentages of the base policy compared to the paid up additions and all of that stuff. I think it depends. Okay, but I'm going to leave it at that. I don't want to get too far complicated or deep, but it is about the funding because at the end of the day, what you're trying to do is you're trying to put this money away. And whenever you put this money away, it sits and grows. So when it sits and grows, it'll still continue to sit and grow, even though you borrow against that policy. And I can't stress enough, you borrow against that policy. Picture it as if it was a piece of real estate and you're doing a refinance. A lot of people are doing that right now. It slowed down a little bit, but because the interest rate went up slightly, but because of the low interest rates, because of the pandemic and things like that, people decided to either one, they cashed out of their policy, or I'm sorry, not their policy, but they cashed out of their real estate and they put it into some sort of investment, whether that be stocks, crypto, whatever, cryptocurrency or whatever it is, real estate. They took the money out because it was so cheap to do so. But what we're going to see here in the near future, along with gas prices, is everything's been going up. And the interest rates will start to go back up. And so with that being said, it's all about the funding. Refinancing your house, and you're borrowing against your house. Let's just say your house appreciates no matter what, which isn't necessarily the case, but let's just say no matter what, it was appreciating at 5%, just for sake of numbers. It's going to sit there, and even though you have this money loaned out against the actual real estate and you've taken the equity out, it's going to continue to grow. It's going to continue to appreciate. It's the same idea. So you take out this money, you use it for other purposes, whether it's funding for college, whether it's funding a stock portfolio, whether it's funding a real estate portfolio. It's all in what interests you and what your needs are. And realistically, the majority of people who utilize infinite banking are doing it for the simple fact that they're getting themselves out of debt. And then once they're out of debt, they do all kinds of fun stuff. And even then, you don't have to wait to do the fun stuff. You could use most of it for paying down some of your debt and paying it back. And maybe you took out, I don't know, $10,000 and you only needed, you were going to start off with 6 or 7 or whatever the case may be. I mean, I guess it just depends on how extravagant a vacation you're taking and how many people are going. You know, if you got a family of 5, then it's probably going to be expensive. I know I've got a family of 5. And so you could literally do that. You could pay down some of your debt, and then you have your pay down that you're going to do based on a loan you're going to do to yourself. And then it's going to, in my personal opinion, the best way to do it is do it on auto debit back into the policy as loan repayment. It happens automatically. And with infinite banking, the idea is that eventually you're able to finance your whole entire life. And, you know, the way it was taught was that you should be able to pay as much in premium as you make in income. And that's hard to do. That takes years. I've got several policies and I've been doing it for years, and I can tell you it's hard to do. You know, not only are there some limitations on the amount of, you know, death benefit, life insurance, stuff like that you can take out, but it's some, and mind you, there's all kinds of ways to fund policies, everything from There's one company. Well, most companies will do premium financing, and usually you have to have a net worth of $5 million or more, and they allow you these big insurance policies, and it's financed, and usually there's some sort of skin in the game that they make you have. You either pay interest only on the loan for a period of time. You may have to pay all of it. It just depends. You may have to pay part of the premium and interest only. It depends on the company. They're usually a third-party company, but there's another insurance company in particular that they do $5 million net worth, $2.5 million, and they do what's called the up and comer, which is 100. I believe it's if you make $100,000 a year and you've made it, basically six figures for the last 2 years as an individual, or more than 101,000, whatever. They will, they have a program for that. So it all depends. And there's some people who will fund their own policies from another policy. It's as long as you've had it for at least a year or two, you take a certain amount of that and you start a new policy, and of course you pay it back. You're essentially doing premium financing, but you're the one financing the premium. That happens, and there's more aggressive ways that people do that sometimes, and I'm not recommending it or saying that it's bad in any way, so I'm not either way. I mean, I can tell you I've done it personally, and you've got to have a plan if you do it. Let's just say that. And even still, in the grand scheme of things, whenever you work with us, or it should be anyone who does infinite banking, and they help you structure these policies, and they give you choices, and they show you, and they give you this information and inform you, they should be able to help you through the process too. So they should be able to help you if you say, hey, I've got $600,000 in debt because of my house and my cars, and I've got school loans, whatever it is. They should be able to help you based on your policy or policies, depending on the situation, whether you do one big one, or maybe you have to do two smaller ones, or whatever the case may be, or maybe you do it as your income increases. You should be able to adapt as you go and update the debt reduction plan. And the debt reduction plan, whoever's doing it should be able to help you do that, should help lay out a spreadsheet for you and show you the schedule. And when you have that schedule, you stick to the schedule. They do what, as the book says, you're being an honest banker with yourself. So, if you would pay the bank, you should pay yourself. It's just that easy. The bank's not going to take no for an answer, and you shouldn't take no for an answer either. Now, if you're in a pinch, you have the ability to not pay it back. At least not for a period of time. You have 6 months that you can't do it, fine. You'll accrue a little bit of interest, but you'll be able to come back and do it. There's so much flexibility. You get into a pinch and maybe you lose your job and you're like, I don't want to lose these policies. If you've already got cash value in there, you can either have it take loans from the policy, normally it's set up automatically in the event that you don't pay it, it'll automatically take a loan to pay the premiums. You can do that. You can do what's called a reduce paid up, where you can no longer put any more money in the policy, but it reduces a lot of expenses and it'll continue to grow. And you'll still have access to any cash value and stuff like that that's in there. But it's going to continue to grow. So you have options. There's some people who don't want to pay into it forever. Okay, fine. Well, what's the plan? How much do you want to fund? Are you going to utilize it for part of your retirement or all of your retirement? It just depends on how you structured your life. Some people have been structuring their life for many years, and some of them are just now starting. These policies can be used for retirement as well. For retirement planning. So it's all It's all about the funding. There again, I'm repeating myself in a way, but I can't stress that enough. You know, even my wife, I'm like, I'm going to start another policy, and she's like, you're adding to our bills. Why? And I'm like, okay, when I pay these over here, look what happens. And I show her the illustrations, and look how much it's going to increase by. Okay, you can do that. I'm like, I have to remind her every time, because the natural mindset with the cash value permanent policies, life insurance policies, people think of it as a bill, which you shouldn't necessarily think of it as a bill. You're going to pay for life insurance anyway, most of the time, especially if you have loved ones. And even if you don't have loved ones yet, at some point, you're probably going to start a family, or you have a niece or a nephew, or you've got someone you care about. You almost always have somebody that you want to take care of. Doesn't matter if they're yours technically or mentally, or maybe they are yours. I mean, when I say that, I mean, there's people who have loved ones who maybe aren't related by blood, but to them, that's their family, and you want to take care of them, and you can do that. So I can't stress enough. I mean, obviously, I hope that based on some of the things I'm saying and the way I'm trying to explain some of this, that, I mean, it's important to me. It's important to most people. So when you do these things, just know that these things can help consolidate some things. And I tell people, this system of infinite banking is by no means a get rich quick scheme. Can it help you be wealthy? Yes. But is it going to make you rich from one day to the next, like winning the lottery? Well, absolutely not. I mean, the only ones who will get rich overnight is if something happens to you, which is what you planned on and what you wanted was for your loved ones to be able to replace your income, for example. Something happens to you. Maybe it's to pay off the house. Maybe it's a number of things. You don't want them to be burdened with bills, so it pays off all your bills, and you know, they have all the assets, and then there's money left over so they can live on. Whatever the case may be, it's the possibilities are endless. I mean, some people, have people who are like, why do you have so much life insurance? It's like, because, at the end of the day, it benefits my family. I mean, and is it that I just have a ton of death benefit? No, I mean, not necessarily. I mean, it's a good amount, but it's not. I'm maximizing the policies for cash value. And when you do that, you're getting the lowest death benefit you possibly can and keeping the policy tax free. So when I say it's all about the funding, it's all about the funding, because how much money can I put in? That's what I'm concerned about. I'm not necessarily concerned about the death benefit, but the death benefit's a nice bonus. I mean, it really is. And, I'll do some other videos. There's some tax code changes, or actually a change that's already been passed back in December. It won't be implemented until probably Q4. There's a couple of products that are out, but most of the insurance companies don't work that quick. It's usually like third or fourth quarter by the time they reprice and release new products, and they'll put out these new products, and they will actually allow you to put more money into it without causing it to be taxable. Because what happens is it's actually going to it allows you to have a lower death benefit, which means lower insurance expenses, and gives you more room for growth. Because those expenses aren't creating, there's still some expenses, of course, but it's not creating the same kind of drag on the policy as it would otherwise. And not that the ones now aren't good, because a lot of people are wanting to get locked in right now. And I'll go more into that in another video, but a lot of people are rushing to do the policies now because most likely most of these insurance companies are going to give you the option to switch from what's currently in place to the new structure of policies. So, and when I say structure, it's more terms than it is anything. The structure is still going to depend on the financial professional and how they structure those policies. So at the end of the day, it's got to be somebody who knows what they're doing, who's doing it for maximum cash value, and they're trying to do the absolute best thing for you. So anyway, please like, subscribe, hit the notification bell. Hopefully this is helpful. I always invite questions, so please put questions down there. It gives me more stuff to talk about and more content. And at the end of the day, the purpose of me even doing all of these videos is to inform people. Information is what I'm trying to get out there, and ideally good information. I hope that I'm doing that, and I hope I'm giving everyone something useful. So if I am, please do all those things, like, subscribe, and click the notification bell. And like I say, feel free to give me more ideas for content, because I know that there's questions, and maybe there's a need for to know certain things that they want to know, people want to know out there. And there's some of this stuff can be, I talk a lot, so it probably gets a little confusing, but I'm always wanting to explain things away, and hopefully I don't confuse when I do it. But anyway, we'll catch you on the next one.